History is full of examples which demonstrate that too much or too little money in the economy is damaging for everyone.
Massive inflation in Germany in the early 1920s illustrated the disastrous consequences of flooding the economy with money. In order to pay the debts that resulted from the First World War, the German Reichsbank printed enormous quantities of banknotes. This generated inflation until ultimately money was losing value by the hour, and prices were rising to previously unthinkable levels. A large proportion of the German people lost all their savings. The damage is just as great if there is not enough money in the economy. This leads to deflation, as in the 1930s, when Switzerland was also pulled into the global depression. Goods were left sitting on shelves and in warehouses, and prices fell. Economic momentum faltered, businesses were forced to close, and millions lost their jobs.
While times of deflation can produce a vortex that pulls the entire economy down into a depression, inflationary phases ratchet the demand for goods and output higher and higher. Sooner or later, the economy overheats, and this ultimately leads to an upward spiral in prices. The aim of the National Bank is to prevent inflation or deflation from taking hold in the first place. It does this by attempting to supply the economy with the right amount of money, not too much and not too little. But how exactly does the National Bank achieve this? In controlling the money supply, it works in partnership with the commercial banks. Repurchase or repo transactions with these banks constitute the National Bank's most important instrument to steer the supply of money.
A normal working day in Department 3 of the National Bank in Zurich. There's very little difference between this room and a dealing room in any other bank. Yet, in many ways, this is the nerve center of our economy's money supply. At exactly 9 o'clock, the National Bank intervenes in the Swiss franc money market from this very room. The bank's staff notified banks in Switzerland and abroad of the new repo rates. First of all, factors such as the events of the previous day, the situation on the financial markets, and the level of the US dollar against the euro, for example, are all analyzed. It is then decided how much money the National Bank will make available to the commercial banks today, and at what repo rate.
The basic principle is simple. In order to guarantee the liquidity required by law and to settle payments, the banks need money from the National Bank. This is provided by the National Bank at a certain interest rate, the repo rate, against collateral. The National Bank provides these funds for 1 day, 1 week, or several weeks. But as the loan expires after this period, the banks must then go back to the National Bank. In this way, the National Bank controls interest rates and exerts an indirect influence on the performance of the economy.
The National Bank operates a fully automatic system for its repo transactions. The interest rate at which the bank provides money is entered in the system and then transmitted simultaneously to all commercial banks.
Gut, 14 Tage schicken, Tomnetz checken und der Auenheit.
Time is ticking away. The banks now have 10 minutes to decide whether or not they are going to trade with the National Bank on these terms and, if so, how much money they want. Each beep means a request for up to 100 million Swiss francs.
The The commercial banks submit requests totaling about 5 to 15 billion Swiss francs to the National Bank each day. Some days the orders total over 20 billion. Today it's 11 billion.
12 minutes past 9. The orders are still being printed out for checking.
As is the case most days, the total value of all orders exceeds the amount that the National Bank wants to release through repo transactions. The amount allocated to each bank is now reduced in line with its original request. These sums are then credited to the sight deposit accounts that the banks hold at the National Bank. In return, the banks supply the National Bank with securities of the equivalent value. These securities are drawn from a group or basket that has been defined in advance by the National Bank and is reserved by the commercial banks for their repo transactions.
The National Bank uses repo transactions to manage interest rates for short-term money. In doing so, its aim is to keep its base rate, the LIBOR interest rate for 3-month investments in Swiss francs, within its set band.
The LIBOR interest rate target range is the public indicator of the National Bank's monetary policy course. When the bank changes the LIBOR band, the money supply can be expected to shrink or expand accordingly. The National Bank regularly checks whether or not the LIBOR target range is positioned correctly. The decision is based on observations and figures on the development of prices and the economy as a whole, which are used to draw up a forecast for inflation.
Let's assume that inflation forecasts point to rising prices. In this case, the National Bank will raise its target range for the LIBOR rate and charge more for repo transactions. What happens then? Banks demand less money from the National Bank and raise their own lending rates. This means that there is less money available to the economy and that it is more expensive to borrow. With its policy of tightening the money supply, the National Bank reduces the risk of inflation. If inflation forecasts indicate that prices will fall, the National Bank will inject more money into the economy. It does this by reducing its target range for the LIBOR and the interest it charges on repo transactions. As a result, the banks cut their own lending rates and there is more money available to the economy at lower cost.
Monetary policy is a delicate balancing act. If the National Bank cuts interest rates too far, too much money enters into circulation and the risk of inflation grows. If interest rates are too high, not enough money is available and recession looms. With its target range for the LIBOR rate, the National Bank can indicate to the economy whether it intends to expand or restrict the money supply. Repo transactions give it a means of steering the money supply on a day-to-day basis. The bank can therefore fulfill one of the main elements of its mandate, ensuring Switzerland's price stability and facilitating balanced economic growth.